Topic explains that stress testing is a critical risk management technique used by financial institutions to evaluate resilience under adverse economic and financial conditions. Stress testing assesses how institutions perform during extreme but plausible scenarios involving market disruptions, economic recessions, liquidity shortages, operational failures, or geopolitical shocks. Unlike standard risk models that rely heavily on historical data and normal market assumptions, stress testing evaluates forward-looking events that may not have occurred previously. Regulators require stress testing because financial crises demonstrated that traditional risk measures often underestimate vulnerabilities during periods of severe stress. Effective stress testing helps institutions identify weaknesses, improve preparedness, and strengthen capital and liquidity planning frameworks. Stress testing frameworks generally include sensitivity analysis, scenario analysis, and reverse stress testing. Sensitivity analysis evaluates the impact of changes in individual variables such as interest rates, inflation, unemployment, or credit spreads. Scenario analysis examines the combined effects of multiple adverse events occurring simultaneously across financial markets and economic systems. Reverse stress testing begins with a hypothetical institutional failure and identifies scenarios that could cause such an outcome. Institutions design stress scenarios using macroeconomic, financial, operational, and geopolitical assumptions to assess vulnerabilities comprehensively. These exercises help management understand risk concentrations, evaluate contingency plans, and determine whether capital buffers and liquidity resources remain sufficient during stress conditions. Stress testing supports strategic decision-making and regulatory compliance by providing forward-looking insights into institutional resilience. Boards of directors and senior management use stress testing results to evaluate risk appetite, capital adequacy, portfolio exposures, and operational preparedness. Regulatory authorities increasingly expect institutions to integrate stress testing into enterprise risk management frameworks and routine governance processes. Stress testing also improves communication between business units, risk managers, and regulators by highlighting vulnerabilities that may not appear in normal risk measurements. Institutions conduct regular stress testing exercises covering credit risk, market risk, liquidity risk, operational risk, and cyber risk. Effective governance ensures that stress testing assumptions, methodologies, and interpretations remain realistic, transparent, and appropriately challenged. Topic also focuses on the challenges involved in modeling losses and revenues under stressed conditions. Financial institutions rely on quantitative models to estimate how adverse scenarios affect profitability, credit losses, trading revenues, operational performance, and capital levels. However, accurately modeling stress outcomes is difficult because severe market disruptions often involve unprecedented behavior, rapidly changing correlations, and limited historical data. Traditional statistical models may underestimate losses when extreme events occur simultaneously across multiple risk categories. Institutions must therefore incorporate expert judgment, scenario analysis, and conservative assumptions into stress testing models to improve reliability and capture potential tail risk exposures more effectively. One major challenge in modeling losses and revenues is the uncertainty surrounding behavioral responses during crises. Borrowers, investors, customers, and market participants often react unpredictably under stress conditions, making revenue forecasting and loss estimation highly complex. Correlations between asset classes may increase sharply during crises, reducing diversification benefits and amplifying losses. Liquidity shortages, operational disruptions, and reputational damage may further intensify financial stress beyond model expectations. Revenue projections also become uncertain because trading activity, customer demand, and financing conditions can deteriorate rapidly during economic downturns. Institutions must therefore recognize model limitations and supplement quantitative outputs with qualitative analysis and management judgment when evaluating stress testing results. Effective stress testing and robust modeling practices strengthen financial stability, institutional resilience, and regulatory oversight across the financial system. Institutions that understand the limitations of stress testing models are better positioned to identify vulnerabilities and prepare for unexpected disruptions. Continuous improvement of stress testing methodologies, data quality, governance structures, and scenario design helps organizations adapt to evolving market conditions and emerging risks. Regulators increasingly emphasize transparency, conservatism, and operational integration within stress testing frameworks to ensure institutions remain resilient during severe economic and financial shocks. Ultimately, stress testing and careful modeling of losses and revenues support sound decision-making, stronger risk management, and sustainable long-term organizational performance in uncertain financial environments.